There is a narrative circulating quietly across financial media in early 2026. It sounds sophisticated, it sounds cautious, and because it sounds cautious, investors assume it must be intelligent. The narrative says this: markets are calm, credit is fragile, liquidity is disappearing, a storm is coming. It's persuasive, but persuasive narratives are not the same as accurate frameworks, and the most dangerous mistake an investor can make right now is confusing the language of risk management with the reality of macro positioning. Because what many people are calling complacency today may actually be something very different: structural resilience. The claim that markets are ignoring danger assumes something important: that investors are blind. But institutional capital rarely moves blindly for long. When equities trade near highs while employment remains strong, earnings remain stable, and financial conditions remain orderly, this is not necessarily denial. Sometimes it is recognition that the system has already absorbed the shock cycle that began in 2022. And that distinction matters. Every cycle produces its own mythology. In inflation cycles, the mythology says tightening destroys growth. In easing cycles, the mythology says liquidity creates bubbles. In recovery cycles, the mythology says optimism equals complacency. But optimism is not the same as fragility. The assumption that calm markets must precede crisis is emotionally satisfying, yet analytically incomplete. Markets do not crash because they are calm. Markets crash because something breaks. And today, despite elevated uncertainty across geopolitics, monetary policy transitions, and credit normalization, there is very little evidence that the core transmission mechanisms of the financial system are failing. That doesn't mean risk is absent. It means risk is different. A great deal of commentary today focuses on psychological indicators: confidence returning, margin exposure rising, speculative behavior reappearing. These signals are real, but they are also cyclical artifacts. They appear in every expansion phase following tightening cycles. Confidence returning after fear is not a warning sign. It is the definition of recovery. The real question is not whether investors are becoming optimistic again. The real question is whether optimism is unsupported by liquidity, earnings durability, or balance sheet strength. And so far in 2026, the evidence suggests the opposite. Corporate refinancing pressure has moderated. Labor markets remain adaptive rather than collapsing. Consumption has slowed, but it has not broken. And most importantly, financial institutions themselves are structurally stronger than they were during previous late-cycle transitions. That changes the interpretation of the moment entirely, because what looks like complacency from a distance may actually be capital rotating back into risk assets after surviving the most aggressive tightening cycle in decades. Investors are not ignoring risk, they are repricing it. This distinction is critical. There is also a deeper misunderstanding embedded in the popular warning narrative: the belief that equity markets should react before credit markets stabilize. Historically, the opposite is often true. Credit markets do not always lead crises. Sometimes they follow them. Sometimes they confirm them only after equity repricing has already begun. And sometimes they never signal systemic stress at all. Treating credit spreads as prophetic indicators rather than contextual signals risks oversimplifying the structure of modern financial cycles. Markets today are not operating inside the same framework that governed 2008. Dealer balance sheets are smaller. Liquidity provision is algorithmic. Treasury markets are structurally different. Corporate leverage is distributed differently across sectors. And central bank signaling has become more transparent than at any point in modern monetary history. In other words, the system investors think they are preparing for may not be the system they are actually trading in. This is the first mistake serious investors must avoid: preparing for the last crisis instead of interpreting the current one. Because the real architecture being rebuilt in early 2026 is not complacency. It is normalization after stress. And confusing normalization with fragility is how investors position themselves defensively at exactly the moment the cycle begins shifting forward again. In the next section, we will examine the second major misconception shaping investor behavior today: the belief that liquidity is quietly disappearing beneath the surface of markets when in reality something far more complex is happening. If there is one argument repeated more than any other in early 2026 market commentary, it is this: liquidity is disappearing. Primary dealers are shrinking balance sheets. Market makers are cautious. Treasury volatility remains elevated. Reverse repo balances have declined. And therefore, the conclusion follows: markets must be fragile beneath the surface. It sounds convincing, but the conclusion depends entirely on how liquidity is defined. Because what most investors call liquidity today is not the liquidity that actually determines whether markets break. Modern liquidity is not a static pool of capital sitting inside dealer inventories waiting to support prices. That version of liquidity belonged to an earlier financial architecture, one that existed before post-crisis regulation reshaped balance sheet incentives across the global banking system. Today, liquidity is dynamic. It moves. It reallocates. It responds to policy signals faster than at any point in market history. And that changes how risk should be interpreted. The assumption that lower dealer balance sheet capacity automatically creates fragility ignores a critical transformation that has taken place over the last decade. Risk intermediation has not disappeared. It has migrated from banks to asset managers, from market makers to systematic strategies, from inventory-based liquidity to flow-based liquidity. This shift does not eliminate volatility, but it changes where volatility originates. In older market structures, instability appeared when dealers stepped away from quoting markets. Today, instability appears when positioning becomes crowded across systematic strategies that respond simultaneously to volatility triggers, trend signals, or macro surprises. In other words, the risk is no longer absence of liquidity. The risk is synchronization of liquidity behavior. That distinction is essential because synchronized positioning creates fast moves, not fragile systems. Markets can move sharply without being structurally weak, and investors who interpret volatility as fragility often misread opportunity as danger. There is another misunderstanding embedded in the liquidity narrative that deserves attention. The idea that high trading volume guarantees exit capacity during stress. It does not. Volume is activity, liquidity is absorption capacity. They are not the same thing. However, interpreting this difference as evidence of imminent market instability misses the broader structural reality. Institutional liquidity today is not designed to prevent price movement. It is designed to allow price discovery. That is a feature, not a flaw. When markets adjust quickly, they often stabilize faster. Slow adjustments create hidden stress. Fast adjustments release it. This is why the idea of a liquidity mirage has become popular, but incomplete. Yes, market depth changes during volatility events. Yes, bid-ask spreads widen. Yes, execution quality deteriorates during stress windows. That has always been true. What has changed is not the disappearance of liquidity. What has changed is the speed at which liquidity reallocates. And faster reallocation is often interpreted incorrectly as weakness rather than adaptation. Another widely cited signal today is the decline in the Federal Reserve's reverse repo facility usage. Many analysts interpret this as proof that excess liquidity is leaving the system. But reverse repo balances falling does not automatically mean liquidity is tightening. It often means liquidity is redeploying. Money that once parked safely at the Fed is moving back into Treasury issuance, private credit markets, and short-duration funding channels that support real economic transmission rather than passive balance sheet storage. In other words, liquidity is not disappearing. It is circulating again. That circulation is what expansion phases look like. It is also important to understand that liquidity crises do not begin because liquidity is low. They begin because confidence disappears faster than balance sheets can adjust. Confidence is the transmission mechanism, not reserves, not dealer positioning, not reverse repo balances, confidence. And today, despite persistent geopolitical uncertainty and elevated rate volatility, institutional confidence remains far more stable than market commentary suggests. Credit markets are functioning, funding markets are functioning, settlement systems are functioning, and when those systems function, markets adapt rather than collapse. This is the difference between a fragile market and a transitioning market. A fragile market breaks when pressure appears. A transitioning market reprices when pressure appears. Investors who cannot distinguish between those two environments often mistake adjustment for instability and caution for danger. In the next section, we will examine the third major misconception shaping defensive positioning today: The assumption that long-duration government bonds remain the safest protection when volatility returns. For decades, investors were taught a simple rule. When stocks fall, long-duration government bonds rise. It was one of the most reliable relationships in modern portfolio construction. It shaped pension allocation strategies, risk parity models, and institutional diversification frameworks across the world. But the assumption that this relationship still operates the same way today deserves closer examination. Because correlations are not laws of physics, they are products of macroeconomic regimes. And regimes change. The traditional stock-bond diversification model worked exceptionally well during the long disinflationary period that followed the early 1980s. Inflation declined steadily. Central banks gained credibility. Interest rates moved structurally lower across decades. In that environment, government bonds naturally served as a shock absorber whenever growth expectations weakened. But today's environment is not defined by disinflation certainty. It is defined by inflation uncertainty. That difference alone alters how Treasuries behave during stress episodes. When inflation becomes part of the risk equation rather than a solved problem, long-duration bonds stop functioning as automatic protection and begin functioning as macro exposure. They become directional again, and directional assets cannot always hedge portfolios during volatility events. This does not mean Treasuries are unsafe. It means they are conditional. That distinction matters more than most investors realize. One of the clearest lessons of the past several years has been that long-duration bonds can fall at the same time equities fall when markets reassess inflation expectations, policy credibility, or fiscal sustainability simultaneously. When this happens, diversification weakens exactly when investors expect it to strengthen, and that creates positioning risk. The misunderstanding begins with duration itself. Duration is not simply a measure of maturity. Duration is sensitivity to interest rate movement. The longer the duration, the greater the sensitivity. When yields rise quickly, whether because inflation surprises, fiscal issuance increases, or global capital reallocates, long-duration bonds behave less like protection and more like leveraged exposure to rate volatility. That changes the role they play inside portfolios. Investors who still treat long-duration treasuries as guaranteed crisis hedges may be anchoring their expectations to a regime that no longer dominates global markets. This shift became visible during multiple recent stress windows. In moments when liquidity tightened globally, investors did not always rush into long-duration bonds first. Instead, they moved toward shorter duration instruments, cash equivalents, and flexible funding assets that preserved optionality rather than locked-in interest rate sensitivity. That behavior signals something important. Safety today is increasingly defined by flexibility, not maturity length. Flexibility allows investors to respond. Rigidity forces investors to endure. And endurance is not the same thing as protection. There is also a structural component shaping Treasury behavior that investors cannot ignore: fiscal scale. Government bond markets today operate at a size and issuance pace very different from previous cycles. As supply increases, the investor base supporting that supply becomes more diverse and more sensitive to global capital flows rather than purely domestic policy expectations. This makes Treasury pricing more interconnected with international positioning decisions than many traditional models assume. In practical terms, it means Treasuries still matter, but they behave differently than they once did. They remain foundational instruments. They remain central to global collateral systems. They remain essential to risk management frameworks, but they are no longer automatic shock absorbers in every volatility scenario. Understanding this change does not require abandoning defensive positioning. It requires refining it. Short-duration instruments, liquidity-preserving allocations, and flexible reserve capital increasingly perform the role that long-duration bonds once dominated inside traditional crisis protection frameworks. And investors who recognize this shift early gain something extremely valuable: choice. Because protection in modern markets is not about hiding inside a single asset class. It is about preserving the ability to act when conditions change. In the next section, we will examine the final and most important misconception shaping investor behavior today: the belief that market dislocations should be feared rather than prepared for as strategic entry environments. One of the most persistent misunderstandings in modern investing is the belief that market dislocations are events to avoid. They are not. They are events to prepare for. The difference between those two interpretations determines whether an investor reacts defensively to volatility or uses volatility as a structural advantage. Across financial history, the greatest wealth-building periods have rarely occurred during stable markets. They have occurred during moments when prices temporarily disconnected from fundamentals, moments when uncertainty forced investors to make decisions under pressure rather than comfort. Dislocations are not failures of markets. They are resets of expectations, and resets are where capital reallocates most efficiently. This is why experienced institutional investors do not spend their time attempting to predict the exact timing of the next correction. Timing corrections precisely is almost impossible. Instead, they prepare for conditions under which corrections become actionable. Preparation is the strategy. Prediction is the distraction. Much of the commentary surrounding potential market instability today assumes that volatility itself represents systemic weakness. But volatility is not instability. Volatility is adjustment speed. Fast adjustments feel dangerous. Slow adjustments feel safe. Yet history shows that fast adjustments often shorten crisis cycles by forcing repricing quickly rather than allowing imbalances to accumulate silently over years. In this sense, volatility is not the enemy of investors. Unprepared volatility is. This distinction explains why disciplined investors behave differently when markets shift rapidly. They are not attempting to guess bottoms. They are not reacting to headlines. They are executing frameworks designed long before stress appears. Frameworks create clarity, and clarity creates opportunity. One of the most important structural advantages an investor can build ahead of dislocation periods is liquidity optionality. Optionality means the ability to act while others cannot. It means having capital available when forced sellers dominate price discovery. Forced sellers do not sell because assets are worthless. They sell because they must. Margin calls create sellers. Redemptions create sellers. Leverage unwinds create sellers. And when sellers are forced rather than voluntary, pricing temporarily stops reflecting long-term value. That gap between price and value is where asymmetric opportunity appears. Institutional investors understand this dynamic deeply. They do not view crisis environments as random destruction events. They view them as capital transfer mechanisms through which disciplined liquidity replaces fragile leverage. This is how cycles rebalance themselves. It is also why investors who prepare ahead of volatility often experience market corrections very differently from those who do not. Prepared investors experience volatility as access. Unprepared investors experience volatility as loss. The difference between those two experiences rarely comes from intelligence. It comes from structure. Structure means knowing in advance which assets you are willing to accumulate during stress environments. Structure means identifying balance sheet strength rather than narrative strength. Structure means maintaining reserves that allow action instead of reaction. And perhaps most importantly, structure means accepting that uncertainty is not a signal to retreat from markets. It is the mechanism through which long-term positioning becomes possible. There is another misconception worth addressing here. Many investors believe opportunity appears only after markets stabilize. In reality, opportunity appears before stability returns. By the time headlines become calm again, repricing has already occurred. Risk premiums compress, volatility declines, and the asymmetric entry window narrows. This is why professional investors rarely wait for confirmation signals from public narratives before reallocating capital. They act when uncertainty remains elevated, but structural damage remains limited. That window is uncomfortable, but it is powerful. Understanding this changes the role volatility plays inside an investor's framework. Instead of representing a threat to avoid, volatility becomes a signal that price discovery is accelerating. And accelerated price discovery creates temporary inefficiencies. Temporary inefficiencies create opportunity. An opportunity, when approached with preparation rather than emotion, becomes the foundation of long-term capital growth across cycles. Markets do not reward prediction, markets reward preparation. Investors who recognize this difference stop asking when the next dislocation will arrive. They start asking whether they will be ready when it does.